Knowing the potential of an asset is critical to investors. So it is for stocks, bonds, real estate, or commodities like silver. Investors sometimes look to past performance to see where an investment could go in the future, and if you know silver, you know we're a long way from its all-time high. But the story behind silver's all-time high is a complicated one, involving fraud, deception, and a cautionary tale of excess greed. Today we're going to look at the events of the past with a critical eye and uncover what silver's true all-time high really is and what that means for the silver investor in our current market. Silver recently crossed a decade high this year, and by all accounts it is due to move higher. Everyone wants to know, how high can it go? To answer that question, retail investors will often look to silver's prior all-time high and measure the difference. A few times in history, silver has soared to some amazing prices, and the most infamous was in January 1980 when silver went to $49.45 per troy ounce. In today's dollars and accounting for inflation, that would be the equivalent of $188.48. Silver again approached the $50 mark in April of 2011, reaching $47.94 in the wake of the global financial crisis. This would be the equivalent of $66.94 when accounting for inflation. Should either of these numbers be referenced when considering silver's all-time high? The events in 1980 were unusual and in today's world, likely unrepeatable. The Hunt brothers were responsible for the run-up in silver's price and its subsequent and dramatic collapse on March 27, 1980, an event known as Silver Thursday. The Hunt brothers, Nelson and William Hunt, were the sons of Haraldson Hunt, a legendary oil tycoon. Born into extreme wealth, the brothers were raised to inherit and manage the vast sums their father had accrued. Nelson preferred high-stakes investments, substantially adding to the family's wealth by investing in oil fields in Libya. William, though more reserved, matched his brother's ambition. Together, they hatched a plan to corner the silver market in the early 1970s and began buying substantial amounts of silver. Nearly a decade later, the brothers had accrued a large portion of the world's silver supply. Disaster struck when they missed a margin call, triggering a series of events that led to a price collapse from almost $50 per troy ounce to just $10.80 per ounce. The fallout caused widespread losses to individual investors, brokerage firms, and banks. The ripple effect was so severe, the Federal Reserve intervened to stabilize markets. The Hunt brothers declared bankruptcy in the aftermath, losing the family fortune and the respect they had once earned for their financial acumen. Not only did these events set in motion a dramatic rise and fall of silver spot prices, but it also paved the way for stricter regulations. Daily price limits, position limits, and stricter margin requirements make it substantially more difficult for the silver market to experience another similar event. Silver's all-time high should not be judged on the events of 1980, but instead we should look to 2011, when silver saw its price rocket upwards to $47.94. Remember that adjusted for inflation, this would be the equivalent of almost $67 per troy ounce. Silver's price hike in 2011 occurred in the wake of the 2008 global financial crisis. Most viewers watching this will remember the collapse of Lehman Brothers, a weak US dollar, inflation concerns, rising gold prices, supply constraints on silver, and the heavy-handed use of quantitative easing to prop up a failing economy. While some may say there was a perfect storm of events leading to silver's rise, we see many of those same factors at play today. We had a pandemic in 2020 that ground the global economy to a halt, quantitative easing a la stimulus checks, the collapse of Silicon Valley Bank in 2023, rampant inflation, rising gold prices reaching new all-time highs, and again, we have supply constraints on silver. They say history doesn't repeat, but often it rhymes. Just as a wave of investment in green energy initiatives in 2011 led to supply shortages in silver, we are doubling down and investing further in the green energy revolution today. This is generating concern about the total silver supply available to keep the world running. We have been at a deficit since 2019, and we do not expect that to change in the near future. If anything, it's expected to become more pronounced as the world consumes more and more silver. Solar panel production alone is expected to use 85 to 90% of the mined silver supply by 2050. The all-time high for silver was reached in 2011 due to a confluence of similar events as to what exists today, and that high was either 47.94 or 66.94, depending on whether you want to adjust for inflation or not. Today's silver spot price is $29.70. To get to the all-time high, silver would need to rise by 61%. To reach its inflation-adjusted all-time high, silver has room to grow another 125% before another record is broken. The 2008 global financial crisis may have pushed silver to its all-time high, but remember, it took a few years from the start of the crisis in 2008 to reach the peak in 2011. We should not expect the effects of a global pandemic and ongoing bank crises to play out immediately. This is important context for today's silver stacker and precious metal investors. As silver has reached a decade high, some investors are now sitting on the sidelines asking whether or not it has the potential to go further. History shows us it does. To get the most value out of a silver investment, some investors are turning to products with lower premiums. Silver products all have slightly different features. Some coins are meant to be purchased as collectibles, which tend to be insulated a little more from fluctuations in the spot price of silver. If you're worried the spot price might be reaching a peak and want some room to guard against a drop, a numismatic or semi-numismatic silver coin might be a good option for you. Sometimes the collectible value grows so high, the silver spot price becomes largely irrelevant. Peace dollars from the 1920s that are graded and slabbed in excellent condition frequently sell for hundreds of dollars, well over spot. But if you're purchasing bullion, the value of your investment will track closer to the spot price of silver because it does not have a collectible premium. And when silver prices are rising, there is sometimes a preference for the coins and bars with lower premiums as the distance from the all-time high compresses, limiting theoretical returns. Silver bars in 10-ounce and 100-ounce formats are popular for low premiums. Silver coins from sovereign mints remain in demand in virtually any market condition. Some investors will always choose silver eagles as they are sometimes sold for a premium over spot while demand is high. But ultimately, the silver products you choose should be the ones you are happiest and most comfortable with. If silver Morgan dollars are how you prefer to invest in that. There isn't a particular right or wrong way to store wealth in silver, just slightly different strategies based on market conditions and personal preference. And as always, we remind our viewers the often repeated advice from financial advisors around the world that time in market beats timing the market. It's all we have for you today. Please remember to like, subscribe, and share with a friend. Thanks for watching, and we'll see you next time.